Well, here we are. It's 11 o'clock and time for our first show of the new year. And I'm joined today by Andrew McHattie and also by Gavin Lunson, who's our newest recruit.
Hi, James. Yeah, lovely to be here. I've joined QuotedData as head of news, so I'm going to be covering the London-listed funds market in all its varieties. And yeah, I'm very glad to be here and looking forward to what you and Andrew got to say.
Thank you very much indeed, and do chip in as we go through the sectors. So the format of this, we've done this same thing every year, but we're just going to run through each sector. We're going to look at the best performers and the worst performers. We'll have some comments and things. If you want to put questions into the chat box, please do that. Andrew's going to be keeping an eye on it for us, and he'll relay those to us. We're going to probably, because there's just a lot to get through, run beyond 12 o'clock. So please do bear with us. And obviously, if you can't sit and watch everything, then do catch up with it on YouTube later on. So over to you, Andrew, for the first of these.
Tremendous. Thank you very much, and welcome, Gavin, as well. I'm looking forward to this annual romp through the sectors, and we're going to begin with the global sector. But before I start, I'll just explain three quick things about the figures you can see on the screen. The first one is that all of these tables are ranked by 1 year NAV performance, with the best performers at the top. And where you see the 3-year and 5-year figures there, those are all annualized, so that will help to make sense of them. On the right-hand side, we have a blue box with some figures for NAV and price and a relative index. Those figures are medians, so they're just really to give you an idea of what the average was. So let's kick on with the global sector. This is always very important to talk about because so many people have holdings in these big global trusts. They do form the core of so many of our portfolios. And this year, you can see from the table, I hope, that Scottish Mortgage Trust is at the top, which is a wonderful return to form, actually, which actually Scottish Mortgage did do quite well last year. But of course, prior to that, it had a tough patch of performance. But this is such an important trust for our sector. It's a flagship. Everybody knows it. It's a FTSE 100 constituent. So it's really terrific to see its growth strategy paying off again. And of course, of late, it's done very well from its holding in SpaceX, which a number of the Baillie Gifford trusts have as major holdings. And that had a big upgrade to its valuation in December, which helped Scottish Mortgage very considerably. But it's very good to see it there at the top. And I'm always quite pleased as well to see a decent showing from F&C Investment Trust and Alliance Witan, because again, they're very widely held. They're big savings vehicles for many retail investors in particular. And they both did okay. I mean, I think Alliance Witan was a little bit behind where we might have hoped, but certainly not too bad. If we are looking at the negative side of it, I think Lindsell Train actually stands out, which is rather sad. I mean, its growth, its value quality style is very much out of favor, and we've seen that across the Lindsell Train trusts. There's another drag here as well, which is its holding in its management company, which is very substantial. It's about 1/5 of assets. And that because the management company has been losing assets under management, the valuation's been coming down, and that's been a drag. So I do feel there's quite a lot of pressure on that trust to improve. But it's really that value quality style that's out of favor. And I think we'll see that across a number of sectors. And I did note here that Midwind Investment Trust have also blamed that for their slightly mediocre showing as well over the last year. What do you make of these global trusts, Gavin? Anything in particular?
Well, just going back to Scottish Mortgage, it is as a shareholder, amongst many, obviously, but it's very encouraging to see what's going on. I mean, it's at a 3-year high, I think, and it's sort of made back 2/3 of the huge falls it made in 22-23. I mean, 5-year figures are on the shareholder returns, it's exactly flat. So it shows there's still a way to go. But no, I'm encouraged, and the SpaceX news kind of vindicates their approach. personally, I'm thinking, if my holding grows again, I might take more profits than I did in the past. That might be the lesson I've learned there. But no, it's great to see it back. There's some good news today in the papers about Anthropic, one of its holdings, another one of its private equity holdings, is reportedly raising more money at a valuation that's reportedly double what it was 4 months ago. So, yeah, I mean, which I don't know what. That at the same time, though, does revive kind of concerns of bubbly markets and speculation. So I think but I'm glad to see Scottish Mortgage doing well again, and it's always interesting.
Yeah, you're right.
I just want to point out the 5-year numbers now. Something I've been writing about for other things too. What they're capturing is all of that collapse. After we had a big run up in growth stocks during the COVID period when interest rates were slashed and then everything was going their way. And that's largely absent from the numbers now. And what you're getting is all of the downside. So the 5-year numbers are not very indicative of what's going on. So look at 10 years, look at 3 years, and you get a better picture. But that was a real loss for Scottish Mortgage, and we are climbing back slowly.
Fair point. Well, Lindsell Train, I mean, again, right at the bottom there, but is there some, it's worth looking out for, isn't it? Let's see how it goes, because it was on a 100% premium if you go back to the top of the market in like 21 or whatever, and now it's on a 21% discount, I think. So that's a huge derating. I take the point absolutely about the reasons, the factors that are weighing on the share price, but it's come down a long way.
Yeah, definitely. I think we'll look at the style things when we talk about the FNC growth and income. So yeah. Cool, moving on.
All right, yeah, let's move on to global equity income. And again here, I think the same subject is going to arise, which is style. And it's notable here that Murray International is at the top of the pile, which is pleasing to see. I've always liked Murray International, and it's stuck very much to its value guns over the years. And it's spent some time in the wilderness as a result. When growth was really firing, Murray International was at the bottom of the table. Received quite a lot of criticism for that, but actually just said, no, this is our style, we're sticking to it. And my feeling is that that is really what shareholders generally want from their managers, because at the outset what you're buying, and you don't want your jockey changing horses mid-race. So again, I'm very pleased to see it at the top there. It's a major trust that will be in many people's portfolios. One notable aspect to it, which it has used as a selling point, as a differentiator, is that it doesn't have any Mag 7 exposure. And clearly this is a point of worry for many people who are constantly reading in the press about the high valuations of the Mag 7 stocks. And it's an interesting debate that we could have had at any time in the last couple of years, and will continue to have, about whether they're overvalued, whether a setback is going to occur, and how vicious that might be. But if you are concerned about that, then Murray International is possibly something of a safe haven. Probably everything would fall in that circumstance, but that might not be so bad. Again, reading through managers' statements here, I noticed that the Scottish American manager said he hasn't really been in the sectors that have performed. And this is a recurring theme. And I suppose managers who are towards the bottom of the performance tables will always say, well, it's not stock picking that's at fault, it's our sector bias. But we've seen a lot of that this year, I think.
Yeah, definitely. I mean, British American, we should just say, is tiny and really not worth worrying about. It's was massively geared as well with his convertibles. So,
and it has just one major holding in a US biotech company.
Yeah, which goes up and down. Yeah. So no, just leave alone. Yeah, I mean, I do think it's interesting, that style thing, because JP Morgan Global Growth has been caught by this. Invesco Global did really well on the back of having a big exposure to 3i, and obviously through that action, and then that was good, and then we had that sort of profit warning thing later on. So yeah, that's something there. But I liked it because it was doing something genuinely different. I think that's part of the attraction of Murray International too. It's got quite a lot in Latin America, which is, normally you'd be, oh, why do you want to do that? But actually, what was probably one of the best regions to be in last year. So yeah, good on it. I like managers that are fair to, don't sort of hug the benchmarks and are prepared to just go where they have their sort of confidence in, you know.
Yeah, and again, encouraging to see, because obviously Bruce Stout, you know, the long-standing manager, retired there. So his co-managers, is it Martin Conahan and Samantha Fitzpatrick, you know, continue to do a good job.
Yep. Cool. Emerging.
All right, global emerging markets. Now, this was a cracking sector last year. You can see from the blue box there, the median NAV performance up 21%, prices up a bit more as they revalued, and it was a very good place to be. I think there were quite a lot of macro drivers behind the strength of emerging markets, in particular the weak dollar, because emerging markets nearly always do well when the dollar is weak. And that seems to be a fairly central, unspoken plank of Trump's macro policy. And I would expect a bit more dollar weakening this year, although actually forecasting currencies is a devil's job. It's a really tough game. But that has worked. And I think also investors have been looking to diversify away from the US because of the valuations. And they've basically seen better growth and more attractive prices available in emerging markets. If we look at the individual trusts, there's a very clear winner here, actually by a substantial margin at the top, which is Fidelity Emerging Markets. Now, if you are seasoned in the sector, you might remember this used to be Genesis Emerging Markets, and Fidelity took over the mandate. I think it was 2021. And it's an interesting trust, this one, that really uses the investment trust structure. And we've been talking about this a lot recently, and we'll talk about it more today, I think, about whether trusts are really flexing the investment trust structure. Why are they investment trusts? Well, I think in this case, the managers really are using the full toolkit because they can take short positions, they can invest in small and mid-cap stocks, they can use gearing. They are really making the most of it, and it seems to be working exceptionally well. But they are on the clock in the sense that they've got a real target this year, which is to try and make back some of the really unfortunate losses they had when they first took on the trust, when they had large holdings in Russia. I think at the time it was 16% of the portfolio when the Russian assets were essentially frozen and written down to zero. So they've been running to try and catch up with that hole in the track record. And it's important because there is a conditional tender offer this year. That will be in the autumn, I think, if they haven't caught up. And that would be for 25% of the shares. And I'm sure the managers don't want to lose that chunk of assets. So they're going to try and keep up this recent very strong performance, which is extremely encouraging, I think. And if you're looking elsewhere, I always try to find a good consistent trust in emerging markets, which is quite difficult because they tend to ebb and flow quite a bit. But Templeton Emerging Markets generally does look like a sensible choice. And if you're an investor needing liquidity, this is the obvious choice because it's by far the largest trust here and certainly very liquid on a daily basis. If we're looking for disappointments, not that I want to, but Mobius Investment Trust, which really started its life very strongly, has now turned into a very moderate performer, had a very slight loss over the year, in fact. Again, the managers are blaming the quality growth style. What I do like here is that the manager is not shying away from this. They're not trying to ignore the fact that their performance has come off. Carlos Hardenberg is addressing this, and he's been quite frank about it and just said, look, we think our underlying companies are doing extremely well, but they're just not the ones the market is buying at the moment.
Yeah, I do feel sorry for Mobius because, as you say, the good performance has kind of abated, and they were hit by a 43% share redemption just a couple of months ago, which... well, actually, I was preparing for this for our conversation. I was sort of a bit surprised to see that the market value hadn't changed because I don't think that those assets have been sold and the shares not bought back yet. So that raises a question around around these sort of windows. But they're proposing to increase that redemption window from 3 years to 2 years, and I wonder, is that is that a negative for the future of the company?
Possibly,
but I guess if the performance improves, then people will come back, I suppose.
Yeah. Good, thank you.
All right.
Small cap.
Small cap, yeah, and it's a very newsworthy sector in spite of the small number of companies here. And I noticed on the chat I've been asked about Smithson. Let's talk about that first, because that is leaving the sector. That's going to happen, I think, in the first quarter. Um, Now, Smithson is converting to an open-ended format and offering an exit as well to investors. And in some ways, it's not that big a loss. Unfortunately, Smithson did continue the terrible track record of massive investment trust launches going wrong. If you remember, Smithson raised £800 million at a great time in the market, was widely feted. People were expecting a fantastic performance, and it just hasn't happened. It was okay initially, actually, but it's really fallen away, and you can see it had a very poor year last year. So anyway, Saba took advantage of that, took a stake, and Smithson has decided to leave. Now, coming back to this theme of whether trusts are really using the investment trust format, Smithson wasn't really, and it's not going to lose anything by shifting away into an open-ended format, because although its remit is global smaller companies, these are not really tiny companies as we would imagine them. They're actually still quite sizable. So I don't think it's going to have any problem with the open-ended format. We do need to talk about the trust at the top of the pile as well. Edinburgh Worldwide, obviously very much in the news at the moment because of the Saba requisition to oust the board and put in 3 nominees of its own choosing. The vote there is on the 20th of January. But if you're holding your shares through a platform, then your deadline is roughly now. So you really do need to get on and vote to express your opinion there, which is vitally important. But Edinburgh Worldwide it's interesting, if you look at the table there, it's done really quite well over the last year. And a lot of that, again, is down to SpaceX and its unquoted holdings. Its 3 and 5 year performance, its 5 year especially though, is pretty awful. So it did have a lot of catching up to do. And I think Saba's actually posed quite a lot of valid questions here, but it's not offering us a better alternative. And it seems to me that Edinburgh Worldwide is maybe entering a bit of a sweet spot here. And I like the fact that it is investing in global smaller companies, which if it were to merge with Baillie Gifford US Growth, you'd be losing that, I think. So this is a small sector. Smithson is leaving. Edinburgh Worldwide is leaving. It's already shrinking. And this morning we had one more bit of shrinkage for the sector in the news, which was Herald Investment Trust, which I did think was going to have to deal with its Saba stake, because Saba had a massive amount of money here invested in Herald, way more than in any other holding. I think it's about £400 million. So Saba was definitely going to be agitating to get that money out. It's been sitting there for more than a year now. And this morning, Herald announced it's making a 100% tender offer to shareholders at NAV. It's going to make a former realization pool of assets. So it's certainly hoping that Saba will take that up, and it's an opportunity for any other investors who wish to leave to do so. Herald, I think, is a great trust. I own it, actually. I've owned it for a long time. I think it's actually got an exemplary long-term track record. So I wouldn't be in any rush to sell out of that one.
Cool. Yeah, that all makes sense. I think the point is the reason the Saba was so big in this sector was because small cap hasn't been doing very well for a while. So it bought into Edinburgh Worldwide, Herald and Smithson, and it's now trying to find a way out of all these things. I think Edinburgh Worldwide is showing that actually small cap might come right now, and when it does come right, there's an awful long way to go. So small cap's been lagging for a while. It lagged again last year. So yeah, there could be quite a lot of upside still in this sector, I think. Cool. Moving swiftly on. Flexible is one of mine. So Achilles at the top. We've got no info there yet, but you know, that will come in time because it's a relatively new trust. Though the winner in this sector is UIL. Now, obviously, all these things, they're not doing similar things. There's quite a different group of funds here. UIL is a collection of interesting businesses that it tends to have big stakes in, It's already decided that it's going to delist at some point, so it's gradually sorting these things out and buying things out and merging stuff, and there's all sorts of stuff going on corporately. But it's got quite a big exposure to gold through gold mining stocks, and that has been a big winner this year, and that's mainly the reason why the performance is so good. Hansa's done very well too, and it's had a big transaction because the Brazilian maritime business that it's got, which it held through Ocean Wilson, so it had a stake in Ocean Wilson's, which owned this Brazilian thing, that got sold, which realised the sort of capital gain for that. And then it's now doing a deal where it's absorbing Ocean Wilson, so it's going to become a lot bigger. There was someone tried to block that deal, and that got approved in the end. So this is all going to happen. But the company is a bit bid-proof because it's got no voting shares, and that means that it's sitting on a big discount. I don't see that sorting itself out anytime soon. So that's the good stuff. And when you think about the things that are trying to preserve investors' capital, not drop too much when markets fall, McHattie's had a standout year, and it's just a mix of the things it's been buying, and also it's got relatively high exposure to equities, and the trust that is most defensive in there is capital gearing. It's got very low exposure to equities, and obviously that's reflected in the returns that we've got seen there. So if you think markets are going to fall out of bed, then you maybe see some reversal there, but we'll have to wait and see on that. At the other end of the table, we've got obviously diversified income growth, which is in wind down mode. I think those numbers are right. I'm not completely convinced about that because it's been doing selling stuff off and then doing these distributions, and Morningstar doesn't always process these things correctly, but it has been taking quite big haircuts when it's sold some of these funds. So I think that the NAV has definitely gone down a lot, and that position at the table is correct.
Yeah, well, thanks, James. Going back to Achilles, I mean, no figures there, but I'm looking forward to, Andrew was saying earlier that we should get some results in the next couple of months, because it floated or listed last February and actually said very little. It had a successful campaign. So it's an activist fund trying to make money for shareholders out of sort of narrowing discounts and forcing boards to make positive changes. And so it had an early success with urban logistics, which got bought out by London Metric. But yeah, it's all been a bit quiet. But the chief guy there, Robert Naylor, has appeared on... He's the chair of Aquila European now, European Renewables, and he's on the board of
Life Science REIT,
which had some bad news today. So yeah, there's an indication perhaps that the Achilles might be involved in those, but I'm not sure. Yeah, one to watch.
And it has a slightly odd foray into Spire Healthcare as well, which sort of outside its remit, and I don't know what's going on. And then it had a profit warning, and so anyway.
So the shares went up to 110 and then back down to 100. So maybe.
Yeah, exactly. Good. All right, moving on to the UK now. So 3 sectors here, looking at the ones that invest in mostly sort of large cap stuff now. They've got 3 ranging all cap sector first. Top of the pile is Fidelity Special Values, and this actually reflects what Andrew was saying before about style being a big factor in whether you did well or not last year. In the UK, value massively outperformed growth. Not globally, but definitely in the UK that happened. And so you needed to hold those kind of value type sectors, and that includes things like banks, but it also included things like defence companies at some point. So, and whether you held the defence companies made a big difference to how well you did. The other big style thing was whether you're exposed to large cap or small cap, because as we say, small cap's been lagging, and there's quite a big gap between the two. So UK small cap's still very much out of favour. And most of these things, because they're actively managed, tend to have a bias towards small mid-cap companies. So that's been a problem for them. But it's a shame when you look at those numbers that the only fund that actually beat the all-share was Fidelity Special Values. That's not great for the sector, really. On the UK equity income front, much better picture. So we've got far more funds that actually beat the all-share. And obviously they're producing decent yields as well, which is the whole point of these things. Top of the pile there, Temple Bar, which is the sort of poster child for doing value. And it's very good stock selection, really. That's what's been driving it. it's quite good at finding companies that are undervalued because they've got a part of the business that the market doesn't really like, and that they feel they're sort of are often in for free. So ITV is a good example of that. They think that there's a chance of doing a deal with Sky this year that might unlock some value. There's a note of ours coming out on that very soon, I think, so we'll watch out for that. I just thought it was interesting that Jonas Henderson funds have been doing quite well too. So Lowland and Lord of Bench are both up there, and that's good news for them because they had a sort of quieter period more recently. And then at the other end of the table, we've got the things that are more biased towards quality rather than value. And those include things like Murray Income, Dunedin Income Growth, and Finsbury Growth and Income in particular. And obviously that has got a continuation vote imminently. I don't expect it to lose it, even though Nick Train, who's got about 5% of the fund now, has said he's not going to vote his shares. Yeah. But it is going to be really interesting to see what happens. So that vote is on the 15th of January. And then, as I said before, banks and defence, the key. Edinburgh Investment Trust didn't have that exposure, and that's the result you see there.
Yeah. I mean, with as I cover the news, mergers and acquisitions and the consolidation that we've had, remarkable consolidation we've had seen in the past 2 years. The AIC, Association of Investment Companies, called it a frenzy last year. There was just dozens and dozens of mergers and liquidations, that sort of thing. So with all that, the sector very much trying to streamline. One thing that catches my eye is I often wonder, BlackRock Income and Growth. BlackRock, this investment colossus, but the Income and Growth Trust is very small. I don't know, 40 million or so.
Yeah.
I do wonder, what's it doing? Why can't BlackRock have a bigger UK equity in a core sector like UK equity income? I have no idea why BlackRock Income Growth isn't bigger. And if it isn't going to get bigger, maybe it should find a merger partner or something. Something should happen to it.
The more consolidation, I think, is on the cards. Well, actually, one's been announced already. We did see this. Aberdeen Equity Income was going to do a deal with Shires.
Well, that's what made me think of it, actually, exactly. Yeah. And Murray Income has changed manager, gone from Aberdeen to Artemis. So there's a lot going on. And Finsbury Growth facing this continuation vote. So, it would be a major shock if it lost that. But interesting, Andrew, you're talking about you like managers that stick to their knitting and say shareholders do that. Well, Nick Train's clearly been doing that, but there's 20 years of great performance followed by 5 years of well, we can see.
Unfortunate,
It has been abject. Yeah, I had a meeting with Nick actually a couple of months ago, face to face, and he was really wondering what on earth he could do to improve things, and is very much personally affected by it. But the recent track record is absolutely awful if you just look at it as a standalone 5-year period. But obviously, with a longer lens, we remember just how excellent the trust was. So, fingers crossed. I'm sure many shareholders will be hoping there's a significant rotation of style there.
Yeah, exactly. We've seen the same sort of picture here in the small cap sector, actually. So if you've got a bias to quality, you tended to lag. And that is true even of Artemis UK Future Leaders. So they took that fund off Invesco. They actually got control of the portfolio sort of end of March last year. It took a while to rejig it. So only about the 6 months numbers really make sense, but they still would be down towards what the table on that thing. And quality, which is what they do, what BlackRock do, what Montanaro do, has really not been working. And obviously UK small caps just generally been out of favour too. Things like the budget didn't help. There's just huge amounts of money flowing out of the UK market still. I know you wrote a news article about that the other day.
That's right. There was some figures from Calastone Data Company looking at open-ended funds and the flows coming out of that. And it was last year was another bad year for active fund management in general. But UK equity funds have seen 10 successive years of outflows amounting to 56 billion. I mean, against the size of the UK stock market, maybe that doesn't so much, but I mean, it's, but of course last year, the FTSE 100's up 21.5%, giving the NASDAQ a run for its money. And it's like, people are missing out.
Yeah, definitely. Other end of the table, you've got Marwin, which I hold, so I'm quite happy about. It's got a couple of things that just have done very well. this Investec and Sagona. Investec is a funds platform, I think. I'll go and check that.
Sounds right.
Yeah. And those sort of things are good, scoping assets and doing quite well, so that's good. And Rockwood has been the star, is the one that keeps winning our awards every year, and that's an okay year. That's not too bad. I mean, obviously it's slightly below the FTSE Small Cap Investment Companies Index, but yeah, still not too bad.
James, why does Marwin, it's done so well, why does it trade with such a big discount? It's got a kind of private equity type approach, hasn't it? It sort of sets up companies.
Yeah.
And so I wonder, private equities often, there's been a lot of suspicion around valuations in private equity land, maybe undeserved suspicion, but yeah, does Marwin suffer from the same sort of thing?
There are listed companies that it's invested, but they are quite illiquid. And I think they're probably a bit neglected. So, and also, again, we had this thing with Hansa, I feel it's another one that's sort of a bit bid proof. So nobody's going to come in there and beat it up and try and narrow the discount. So back to Andrew. Let's go to Asia.
Yeah, Asia Pacific. So 3 sectors to look at in Asia Pacific, and we've already covered really why emerging markets did well last year. That was very much the case for Asia Pacific, very decent returns of around 20%. I'll just clarify actually, because there's been a bit of discussion in the chat about the figures. They are NAV total returns, so they do include dividends. So if we look here, actually, the returns are pretty good overall. Pacific Horizon at the top, which is good to see. Again, that's a return to form for that trust, which has done very well actually over much longer time periods. But for me, actually, I have to talk about the bad one here because it's so bad. Actually, Pacific Assets Trust has really underperformed massively. It stands out like a sore thumb here. And we have already seen the board addressing this because they've announced a strategic review. There seems to have been a breakdown in communication there between the board and the management. There's been changes at the management house. And it's just a very unhappy picture, I think. And it seems to me it's highly likely we'll see a change of management there. If you look at the 1-year track record, you can see exactly why that's likely to be the case. Outside of that one, pretty good returns though. Not too much to choose between those middle two. I think Schroeder is actually a pretty reliable management house when it comes to Asia Pacific. They have a lot of expertise in the area and generally a good track record.
I think part of the reason for the divergence is also whether how much you had in China and India, because Pacific Assets has got a big bet on India and very little in China, I think. And Horizon's probably more the other way around. And we'll see when we come to those ones. That made a big difference, I think. Here's the income ones.
Yeah. You're right, James. A big divergence in performance between China and India, which we'll come on to. So with the income ones, again, very good performance, actually slightly better than those mainstream trusts we looked at just now, up about 24% in NAV terms, that's the median. But again here, I don't want to be negative about this, but I do want to talk about the laggard because to me this stands out. And we have talked about this on the show a couple of times. And at the risk of boring the subscribers to my newsletter, I've been banging on about this for a very long time, which is that Henderson Far East Income strikes me as a huge anomaly in the sector. Because if you do look at these NAV total returns, it's bottom of the list over 1 year, it's bottom of the list over 3 years, it's bottom of the list over 5 years. It's consistently the worst performer if you're looking at total return. But if you look at the ratings of these trusts, it's on a premium. It's on a premium rating and people love it because it has a massive headline dividend yield, which is still over 10%. It's the highest dividend yield you can get from any equity investment trust. And that just seems to draw investors like bees to a honeypot. And I think it's very misguided because ultimately, for all of us, it is total return that matters. And I think it just poses the question, well, why is this happening? Are investors really that naive? And if they are, then perhaps there are lessons here for trusts that are that are using these enhanced dividend policies now to pay dividends out of capital, where often they're picking some arbitrary level of 4% or 6% of assets. Why don't they make it 10? If you make it 10, maybe you get to trade on a premium rating.
But
I
you
don't
could
know. What do
also
you think?
disappear quite quickly as well.
Yeah.
I don't know the fund that well, but there's a manager change. There's a manager, Sat Dura, isn't he? I mean, what's your view of what he's doing? Is he trying to improve the total return performance, the capital return side of things, while not, immediately cutting the yield?
Well, that's exactly right, Kevin. That's what he said, actually. And again, the board have addressed this. They're not ignoring the fact that they're bottom of the total return table. So they have said, actually, that they are putting more of an emphasis now on the capital returns as well. So yes, the manager is not ignoring that. And I think there is an attempt to make that happen, but it hasn't really happened yet. So I don't think there's any case to be made for the trust at this point.
Yeah, I agree.
All right, smaller companies, a small sector here, only 3. Again, a very differential performance. And I'm slightly puzzled by this one, so I'm going to come back to you on this in a moment. But you can see here that the median return was 15%, but actually we've got Aberdeen Asia Focus at the top there with 17%, and Scottish Oriental smaller companies at minus 11.9, so a huge divergence. And this does happen in the smaller company realm, where stock picking is, of course, so vital. And actually, I look back at last year, where Fidelity Asian Values was the laggard. So things do change, and I think they go through cycles. But it seems to me that Scottish Oriental, which is also managed by First Sentier, the same management group for Pacific Assets, that's a huge differential in the one-year performance. So I think maybe that's a little bit worrying.
Yeah, I agree with you there. I mean, you'd think that they'd be vulnerable, actually, given that long-term track record doesn't look great either. So partly be asset allocation again, but partly it might be this sort of focus on ESG type criteria that First Sentier's got. And that style of investing had a bit of a boom and then a bust again. So it might be that reflected in it too. It probably wouldn't have any defense stocks, for example. Okay, China.
Yeah, China. So we said there was a big differential between China and India. Now, China's so interesting because in the first quarter or the first half of the year, it was underwater. It really wasn't looking very promising at all. Of course, we had Liberation Day and the enormous focus on tariffs, which was extremely negative for China and for sentiment around China. So the market had a very poor start to the year. But actually, it was almost an exact replica of what happened in 2024, when the market was really out of sorts for most of the year and then had a massive rally towards the end in that case, it was a big economic stimulus. But this year, again, it turned around at more or less the halfway point, and then it's had a great rally. So it's ended up being a very strong year. You can see gains of more than 20% here. And Baillie Gifford China Growth Fund is at the top. Good to see again. I think that speaks more broadly to the return to form of Baillie Gifford and their growth style of investing. But it's been good. And overall, I think investors will be pleased. My choice in the sector for a long time has been Fidelity China Special Situations, partly because it's the only one of scale. The other two are still quite small. And I think therefore it's a bit of an obvious choice, but it does have a good, consistent record. The NAV returns over 5 years are not good for any of these, actually, but I do think the Fidelity one is the pick of the 3 at the moment. And what is interesting is that the market is not differentiating between them in terms of the market rating. So in terms of the discount, they're all quite similar, in which case, to my mind, you look at the track record and Fidelity still stand out.
Mm-hmm. Yeah, I agree. In India.
Okay.
Oh, negative.
India. Now, this is very different. NAV declines here on average 11% over the year, a bit worse than the MSCI India, as you can see. All of the trusts did badly. And in a way, this is not a surprise because at the start of the year, there was a lot of focus on the very high equity valuations in the market. And the Indian market was valued at a similar level to the US market at that point, well over 30 times prospective PE, which did seem too high. But then India has a lot of quality, a lot of great companies. And some of the managers say, well, actually, Indian equities are always valued quite highly. But they have come off this year. And it's not really due to any particular macroeconomic disasters, not a huge impact from tariffs. I think it is a valuation adjustment. And we've seen all of these trusts come down. No one did well. I think the standout trust for a while here has been Ashoka India Equity. And again, that didn't do as badly as some last year. So I think actually that preference still remains. And it's always a good test, I think, for trusts that are highly regarded to see just how they do in really difficult markets. Because, of course, sometimes what happens is that they're using more gearing or they're being more aggressive in their stock selection. So they do extremely well on the way up and then get absolutely hammered on the way down. But the fact that we haven't seen that happen for Ashoka India is, again, I think, more reason to think highly of it.
Yeah.
Yeah, I'd put in what about I might put a word in for India Capital Growth. I always quite like the mid-cap focus, and they've got quite a good structure around discount controls, allowing annual exits at increasingly narrow discount, if that makes sense.
Yeah. Yeah, we always liked India Capital Growth as well. I mean, we used to write on it. But I think it's very high valuations in the Indian market, and they probably did get a bit overexcited, but they have got very good earnings growth as well. And the GDP growth is still up there. And it is quite domestic, so it's not really affected if we get a sort of slowdown in global growth as well. So I think India's still probably not a bad place to be long term. And now I've got Vietnam. Well, this is obviously country specialist in terms of if you look at one thing, but now without West Korea, we are just looking at Vietnamese trusts. And it was a funny old market for them last year too. We had sort of a decent start, then real surprise with the tariffs and Liberation Day. They were sort of one of the most affected. Everything dived. Then eventually they did a deal where they've ended up with tariffs of about sort of 20%, which is still high but manageable. But more recently, just in the last few weeks, there's been this one little group of companies called Vin Group. They're not just one company, there's a whole group of them that have just gone mental. And I think Vin Group shares itself have gone up 8 times, and they've massively distorted the market. So that's why the MSCI Vietnam is up by an enormous amount. And these funds didn't like the corporate governance around that, and so they don't tend to hold it. Vietnam Enterprise started buying some after it started to move, and actually that's really why it's performed, and the others just got left behind. So I think what we're saying there is, yes, you've had this one thing go mental and they haven't held it, and that's bad news, but actually the rest of the market hasn't really gone up much this year because of this uncertainty around the tariff stuff. And to my mind, I think that means that it could be on for a better 2026. We'll have to just wait and see. Europe. So I've put the Europe funds there and the small cap funds underneath them. So again, quite a big dispersion in terms of the returns that you've got there. It was a good year for Europe generally because we had that wobble, the deep sea wobble with the big USII stocks at the beginning of the year, and that got investors thinking about, should I have a bit more money outside of the US? And Europe was the sort of big beneficiary of that. And it was interesting that the small cap actually did quite well on the back of that. It wasn't just a move into the large cap stuff, the small cap stuff did well too. And actually they ended up outperforming, as you can see there. Again, it's a question of value versus quality, value quality and value versus growth, and that's distorted the returns there. But JEGI, the JP Morgan So definitely is like stand out here, and congratulations to it. It's good stock selections have driven that really. European Opportunities was disappointing. It had a very big bet, far too big a bet in my opinion, on Novo Nordisk, and that stock halved. That was the sort of big Ozempic play, and when Mounjaro started doing a bit better, it went down a lot. And we had some consolidation too. So European smaller companies did a big tender offer, but then they also took over European Assets Trust. And I think those two funds, the top two funds there, JP Morgan and EST, that they've done very well this year, and they've got good managers. Montenaro's lagged, but that's the quality angle, and that you see that in the UK ones as well. So that's Europe. And Japan.
Yeah, Japan actually did very well last year. This was a country, favoured by many investors at the start of the year. They saw the outlook was quite good, and it's delivered. NAVs up about 18% there, and a fairly close clustering of the top three here. JP Morgan Japanese is slightly below that, but actually that was the best performer last year. So I wouldn't read too much into that. I think that's probably just a fairly normal fluctuation. Again, stylistic elements there coming into play. And Baillie Gifford Japan is back at the top. Again, just the growth stocks coming back into form a little bit. But that trust does have quite a lot of catching up to do because they had a really rough period before that. Baillie Gifford actually was a really preeminent house in Japan for quite a long time. And Baillie Gifford Japan, and as we'll see, Baillie Gifford Shin Nippon were the go-to trusts actually for quite a long time. But that really changed a few years ago when growth fell out of bed. And it's good to see Baillie Gifford Japan at least coming back now. And all four of these trusts are quite different stylistically. If you dig into them and look at what the managers are actually buying, they are all quite different. The two that seem the most similar to me are those two in the middle, CC Japan Income and Growth and Schroeder Japan Trust. If you look at a chart of those two share prices, they've actually been moving pretty much in tandem for quite a long time. So not too much to choose between those two, but otherwise a good choice. But Japan generally did well last year.
There's a small cap.
Small caps didn't do quite so well, and this has been broadly the case that small caps have not matched large cap performance. I think investors have been favouring, as we've been talking about, sectors like banks and defence and energy, and those are generally large cap stocks. So still positive returns here, not quite as good. And here the focus is really on those two activist trusts, Nippon Active Value Fund and AVI Japan Opportunity. They've both done well, actually very similar in many respects. And I think I did wonder whether that activist story really had legs or whether that was just going to be something that worked for a couple of years. But it does seem to me that it is continuing. And it seems it's probably going to be a long journey. And we did see actually last month, Nippon Active Value Fund deliver more proof of concept there with its largest holding in a company called Hoyi Medical, where it's basically engineered a buyout there. It's going to be taken private, although the trust is going to actually maintain some of its holding, but it's getting an uplift from that. And I think we're going to see more of that. So I think the investment case there is still intact. Just one final point here is that we haven't seen Baillie Gifford Shin Nippon really come back yet. I was talking about the resurgence of Baillie Gifford Japan. It hasn't really happened for Shin Nippon yet. I've listened to the manager, actually, a fairly new manager, and I think he makes the case actually with great vigor, and he's very articulate, I think, and I do feel there's a possibility that this trust could roar back to form, but it hasn't happened yet. So I think you'd have to label it as quite speculative at this point.
One to watch for 2026, which we'll see. But when you talk to the managers, the other two, they definitely haven't got a shortage of ideas. So I think that corporate governance thing has got a way to roll. Yeah. North America.
North America, this was actually quite modest in terms of its returns. It wasn't really the place to be last year. Again, those high valuations proving a little bit of a drag. The returns were still positive though, up 12% on average, a little bit ahead of the S&P. I'll just talk about a few things here. At the top there is Canadian General Investments, where we don't have any data. But actually, if we did have the data, it would still be top. I looked it up somewhere else. NAV last year was up 20%. And I've got a bit of a soft spot for that trust, actually. Some people don't like it because it has a majority stake under family control. But that obviously does limit what's going to happen with the discount. There's no scope there for any corporate action, and it is on a tremendously wide discount. But I've met the managers quite a few times over the last 15, 20 years, and they seem to be very sensible, very good guardians, actually, of their money. It really matters, you know, and I think family trusts are a little bit overlooked. They're all on these massive discounts, but I think they can be quite good long-term holdings, actually. Elsewhere here, JP Morgan American is bringing up the rear, actually quite significantly behind some of the others. I feel with this one, rather as I do about JP Morgan Japanese, that I'm not too worried about it. I did look into it because I was a bit surprised, actually, it had lagged this much. And there was a change of managers there a couple of years ago, but I don't think that's the reason behind it.
Yeah, but I'm surprised by that, Andrew, as well, because they have a dual portfolio structure. Am I right? Remember,
Yeah.
they've got a value team and a growth team, and when they launched that a few years ago, you're thinking, oh, how's that going to work? And it did, but I didn't realise it had underperformed so much. What do you think of Pershing Square jumping around a bit, but jumping back to the second on the list, but the top performer, Bill Ackman's fund? I mean, the topic of SpaceX has cropped up a bit in our discussion, and on Twitter, on X rather, Bill Ackman offered to help float SpaceX, and he's often coming through these ideas, and his fund management company's bought into a residential property developer called Howard Hughes, and it's talking about making that a holding company, a kind of Warren Buffett, Berkshire Hathaway style. You know, there's lots going on. I'm just interested in what your view of this. It's a strong performing fund, but on a wide discount.
Yeah, I mean, again, it's kind of bid proof, so there's that aspect to it. There's a lot of noise, as you've highlighted there, Andrew, with Bill, and I think he rubs some people up the wrong way. There's maybe an element of that. The portfolio is quite conservative when you look at it. They're sort of like cash flow generative companies, and they just sort of soldier away and do okay. But there's some interesting bits and pieces in there. They've got this Fannie Mae, Freddie Mac, which is the mortgage finance businesses that were valued at next to nothing for a long time because they after the 2008.
So you bought in after the financial crisis.
Yeah, and there's a chance they're going to get listed this year, so there might be some upside from that. Yeah, it's always an interesting story. I've got a bit of it, and it's done very well for me.
You don't mind the big performance fees that?
Well, it's all part and parcel of the
Yeah.
Cool.
It's very intriguing, that one, because you're right that the core portfolio is actually very conservative, but it's really a core and satellite portfolio, isn't it? And the satellite includes some of Bill Ackman's really quite wild ideas, so that's not to everyone's taste, I think. On the subject of things not to everyone's taste, North American smaller companies, really awful, actually. I mean, I think that's an apt word for it. NAV down 7.3% last year, actually behind the index, but US smaller companies have been lagging really badly, actually, over the larger counterparts. We've seen this in a number of markets. We've seen it in the UK, in Japan, but in the US, it's been really pronounced. This focus on those massive mega cap companies that are driving the major indices means that actually there's very little interest in smaller companies, and they've been terrible. The only nice thing I can say here is that Brown Advisory is not quite as bad as JP Morgan US smaller, but you really, if you look at not just the 1 year figures, but the 3 year and the 5 year, you haven't wanted to own these. And I think it's quite hard to make a case for them because the market hasn't even adjusted so that you can buy these on a 20 discount. The discounts are still sub 10%. So I think it's quite hard to make a case. The only thing I would say is that we know through our long experience that sometimes these things turn around, don't they? And we might get one blazingly good year where valuations catch up. I'm not convinced, but you never know.
I think if the mega cap story cracks, then probably everything will go down. But when you come out the other side of that, people will start to look around a bit more and maybe see the value in the small cap. So we'll have to wait and see.
Latin America next. There's only one trust there now, BlackRock Latin America. And I did say last year, actually, when we were looking at a really dreadful performance, that just the whole of 2024 was absolutely awful for BlackRock Latin America. And I think it went down 35%. But I did say, actually, that historically, this trust has swung around quite a lot. So if you were a brave contrarian, that was the time to buy it. And so it's turned out. It had a cracking year, up 42% in NAV terms, and actually considerably more in price terms, 53%. So a really good showing, actually. Now, that does, I think, raise the question of whether you should bank some profits or not. And whilst we're not giving any personal advice, of course, here, you'd have to think there might be a case for that now, especially if the recent events in Venezuela do start to sour sentiment a little bit and cause some more political worries in the region. I do wonder whether it might be a good time to take some money out. But there's a question here for investors. Do you sell out now? And I think the discount is around 5%. Or do you wait actually for the performance-related tender offer to kick in later in the year? Because the trust has just announced that it's underperformed over the relevant period. I think it was a 5-year period. So it is going to be making a tender offer for 25% of the shares at a 2% discount. So that enables you to get out at a slightly better price. But it's not going to happen for a while. I don't think the resolution for this is going to be proposed until the AGM in May. So it might be June until this occurs. So a bit of that's too long a wait for me. I wouldn't wait for that to happen.
Yeah, it's a good job we don't have to give advice because I wouldn't know what to do.
Yeah.
Okay, now back onto the specialist equity sectors, and we're going to start with Biotech, which has had a cracking year, really. Well, the Biotech part of it definitely has. So that's been out of favour for a long time, really, because we had this sort of big run-up on the back of COVID and all the money that was going into developing vaccines and everything else, and people got quite excited about the sector. And then when interest rates went up, it all sold off quite heavily. But because things had gone down a lot, and because the big pharma companies need to refresh their pipelines and they weren't developing their own drugs, they've started doing a lot more M&A. And so if you were in the right stocks at the right time, you've done extremely well, as you can see there with IBT and Bio. So congratulations to them. They've had a really good year. And then the more speculative end of that is RTW and Syncona, and the difference between those two is just really quite stark. And Syncona's really disappointed, and that just must come down to the things that they've chosen to invest in. They had a sort of row with investors about what they were going to do about that, and talk about effectively taking it private at a discount, and that upset a lot of people. And it's hard to see what the outcome of that will be, really. But it has promised to hand back cash at least, so we'll see that. And then the other one that's been a big disappointment has been Bellevue, and they've stuck with this zero discount policy through all of this terrible returns, and they've seen some massive shrinkage of the fund, and it's still disappearing. They've got a plan now to turn it into a hedge fund run by Columbia Threadneedle, but I'm not sure there's going to be much left by the time we get there.
It's disappearing down the plug hole as we speak.
Yeah. We did see one good result though. So Powdercap Healthcare was offering 100% exit and people did decide, there is more upside in the sector, we're going to roll over. And the rows that the big pharma were having with Donald Trump about drug pricing, that was a negative that was weighing on things. That seems to be being sorted out now. So those could be more upside to come. We'll have to wait and see. Commodities, really the standout winner here, and the best performing trust in the whole investment company sector is Golden Prospect Precious Metals, because with all of the uncertainty in the world, and the gold price has gone soaring upwards, and it looks like it's going to keep going this year. It's one of the few funds, we were talking about this earlier about warrants, it's one of the few ones that still has some way of benefiting from the warrants. They're not traded separately, they're kind of embedded within it. But as you know, because I've been writing about it, there was an opportunity to buy stock in that at 48p in November. And I did that, and they're more than doubled since, that's been great. So I think there is more upside in there. They're still on a biggish discount, despite all of that. We'll have to wait and see. And then gold's obviously helped CQS Natural Resources as well. And that remarkable result came largely after a lot of people ticked the I want the cash box on the back of what Saba did. Really the most value destructive thing that Saba's done, I think, was trying to encourage people to sell that at the bottom, but that's what they did. And it's also helped the world mining too. At the other end is Riverstone. Now that is in wind down, so there's a thing going on there too, but also it's mostly oil, and the oil price has not been quite as buoyant as everything else. And with Venezuela, whether that's going to mean we're going to get even more supply and weigh on the oil price further, we'll have to wait and see, or whether there's actually creates some kind of supply constraint if people start attacking the oil fields and stuff. We just have to wait and see on that. So jury's out of it. And then in the middle of that, you've got Geiger Counter, the uranium story, the whole AI thing. That's just the demand for power. It's just been so huge that you're actually seeing people reopening or building new nuclear power stations, and so there is still upside to come from uranium price. So that's been good too. And
it's the same group that runs three of those: the Geiger Counter, CQS, Golden Prospect. That's all the New City, Manulife managers. Yeah.
And congratulations to them. They've done a good job.
May I just add one very quick point there, which is that Golden Prospect is a small trust. It's still sub £100 million. And I think it's just a reminder, actually, that in our sector, small specialist investment trusts can still be extremely valuable. It's great that they exist.
I completely echo that, definitely. And then three small sectors here. So I mentioned the ESG thing earlier on. I mean, that's still out of favour, and Imbax's numbers show that. The other two funds that it was competing with have both given up. So it's the sole survivor in that sector. It will come right at some point again. It's another example of stick to its knitting, keep doing what it's doing. Yes, there's the whole Trump effect has been a sort of a delay to the inevitable in terms of sorting things out and climate and the environment and stuff. But those drivers are still there, and they will come through in terms of valuations eventually. But going back to the AI power story, that was been brilliant for Ecofin. It had some stocks that went up a lot, and that's just extended that quite decent run of performance from that trust. But that was a two-trust sector, he says. And with the Premier one has now gone, so it's the only one left in that part of the market. And then the other one is financials. Another trust that could have disappeared because it had a 100% exit opportunity, but again, people saw the upside and have been rewarded by sticking with that. Financials are still seem to be on a roll. You've got a lot of things going in their favour in terms of the ability to cut costs, some deregulation stuff. I think, again, there's more upside from that to come. And then Andrew's talked a lot about Augmentum, so I'll let you pick up that.
Yeah, Augmentum's a very interesting case actually, because this trust is on a massive discount to NAV. It's about 45% discount. And I think it's very tempting actually. And it's got some really interesting holdings that could potentially IPO and make quite a lot of money for the trust. Uh, but its performance in the near term hasn't been great. And I think people are not attracted to that at the moment. Growth capital, I think, is still a bit out of favor. So to my mind, actually, what they need is for IPO markets to pick up, and they just need one or two really good exits. And I think that will focus attention on the rest of the portfolio, because I think it's actually very good. There haven't been any troublesome issues really in the portfolio. It looks like a good quality portfolio of really interesting early stage financial companies. And this is where the UK really has an edge as well. You know, the UK is a world leader in fintech. We can't compete with America when it comes to AI. And I think, you know, there's not that much exciting tech in the UK. But I do think this is one way of accessing it. So, no, to my mind, it's a really interesting trust. And I'm sure we'll be talking about it in a year's time.
I'm really pleased to hear you say that, Andrew, because I was thinking along similar lines. Just to add that the interims last month, there's been a bit of a rally since then, because they flagged up that the market value of their shares was basically accounted for by the top four holdings and cash, and that meant the other 23 or so holdings, 125 million pounds of value was is in for free. So I think some investors are saying, yeah, come on, this is oversold.
We'll see.
We'll see.
And then technology, and some good numbers really. We had that sort of DeepSeek scare earlier in the year, but and then the Liberation Day after that, and another sell-off. But post Liberation Day, the AI plays climbed and climbed again. And it was interesting because PolarCap and Manchester London both sort of gone all in on AI. PolarCap is already saying some of those big mega cap stuff are maybe not the best place to be now. And so it's been diversifying its portfolio a bit more. And it's doing very well out of that. And it's outperformed its peers, which is great. But the thing that always strikes me with this is you look at those long-term numbers, and remember these are annualized. So if you multiply up 23.2% a year for 10 years, it comes to a big number. These are still trading on chunky discounts, and it's kind of surprising to me that you can still buy these things for sort of 10% of 10% discount to what they're truly worth.
I mean, the performance, as you say, is extraordinary, but the discount is showing some caution, skepticism towards where Silicon Valley is at the moment.
Yeah, perhaps. Yeah. Back to Andrew.
Yeah, I was just going to say actually that the technology trusts are always actually at the top of the list for interest for private investors. You know, a lot of people own them, a lot of people are interested in them, but I think they do trade them a bit, and so maybe that's why you get the discount. And there's a bit of skepticism now. One other area that I was actually quite surprised at the level of retail interest was debt. I saw a survey actually about a month ago of what private investors were buying, and there was a lot of debt trusts, which surprised me because I tend to gloss over them a little bit, thinking that most people are not that interested because either they're a bit dull or they're a bit esoteric and difficult to understand. But actually, people are buying these, so it is important to look at them. So let's start by looking at direct lending. There are a few sectors here, so we'll break it down. Direct lending, this is an odd little collection because 4 of these 5 trusts are actually in wind down, which throws things out quite often because valuations tend to get adjusted. And what's interesting is that a couple of years ago, if you'd asked me about holding on to trust during wind down periods, I would have said, yes, generally it's a good idea because they work out quite well. Now I'm not convinced that's true any longer because there are so many trusts selling off their assets that very often they're not achieving good prices. They're known to be distressed sellers in the market. Sometimes their NAVs have been overstated. And so generally, actually, I don't think wind downs are working out all that well. And we've seen lots of NAV markdowns during wind down processes. So I've maybe changed my view on that. The one at the top, GCP asset-backed income, is maybe an exception to that. It laid out actually in very considerable detail at the start of its wind down process exactly when it was expecting to get each tranche of repayments. And that's worked out actually very well. It's stuck to it, and the valuations have been maintained there. So that one's all right. Next on the list is biopharma credit. That's the one that's not winding down. And it didn't have a great year last year, but actually it was quite steady. And I do think this is actually a very well-regarded trust. It's a big trust. It invests in, obviously, lending money to pharmaceutical stocks, and I think that sector is really coming into an upswing now. So it does get benefit occasionally when those stocks are taken over, which means its debt is taken out early and it gets extra early repayment benefits from that. I think as well, it's a little bit misunderstood in the market because its dividend yield is often misstated. It's often understated because it does tend to pay a special dividend, and that's sometimes not in the figures. So actually, if you look at the total dividends it paid last year, the yield comes in at 10.5%. So that's very attractive if you are an income seeker here. Just finally, the one at the bottom, VPC specialty lending. We talked about this last year, just how awful it had been, and it's just done the same again, actually, that each time it tries to sell some assets, it finds that they're not really of the right quality. It's marking down over and over again. So that's had a really tough time of it. And it's just shown actually how difficult it is in those really niche, small company parts of the market.
I should probably point out, I think the reason biopharma, the numbers don't look very exciting, I think it's mainly dollar weakness, because I think most of their portfolio is dollar denominated, and that's affected the returns in sterling. Loans and bonds.
Yeah, that's a valid point, and that may well continue as well. So it's something to think about if you are buying dollar assets. Yeah. Loans and bonds next, slightly larger sector here. I think it produced some very solid returns overall. And my sense is that for most retail investors, certainly, who are buying debt funds, this is probably the sector they're buying. And the top two there, CVC Income and Growth and 24 Select Monthly Income, were the two trusts that we picked out a year ago as doing quite well. So they've been actually quite consistent, and you can see that in the long-term returns there. And there is a significant difference between the euro return and the sterling return on CVC there, you'll notice. But I think those two trusts are both quite good. And there's a unique aspect to 24 Select Monthly Income. The clue is in the name, that it pays you a dividend every month, which I find quite attractive, actually. And I think many people do, but it's the only one that does it. And I'm a bit surprised by that, actually. I think maybe there's obviously costs and administration involved, so it's a lot more trouble, actually, for the trust. But I do think we've seen that amongst ETFs and some open-ended funds, and maybe some investment trusts might think about paying their dividends more regularly. And generally here, these are not meant to be exciting funds. The returns are generally going to be lower than they are from equity trusts, but you're getting something different, you're diversifying, and I do think actually debt funds are worth considering. I just did a bit of work actually on the US closed-end fund sector to compare that to the UK. And I was really shocked to find out that actually 56% of the US closed-end funds are bond funds. It's a massive sector there,
It's a different tax
whereas here it
treatment,
really isn't. That surprised me.
Yeah, I think it might be the tax thing, but might be the reason why we didn't have a lot of debt funds for a long time. But then now you can stream the income. Well, you've been able to do that for a while, but that reduced, made it a bit better here. So yeah.
They are purely income funds, aren't they? There isn't much growth. Is that right? I'm thinking, because the sort of underlying yields coming from these portfolios are really quite double-digit territory, aren't they?
Yeah. It is all about the income, and also they're issuing stock. So I've been saying for a while, when we get back to doing IPOs, I can imagine IPOs in this sector, this one particular.
Yeah, I'd agree with that. I think the ratings are very strong, and we might well see that happening. I'm not sure we're going to see any in the property sector, in the debt property sector, though. This has been shrinking. Again, there's only one of these trusts is a meaningful trust that's going to be continuing, which is real estate credit investments. I actually own that one. I've owned it for many years. And what I like about it is that it's just a solid, reliable performer. It's been paying me 3p a quarter every quarter for the last 8 years without exception. So throughout the COVID period, it kept on paying. And it's been really pretty good at dodging most of the problems in the property sector. And I like that. It's good to have that ballast in your portfolio sometimes. So whilst generally there's not much to talk about here, some of these trusts are tiny, they're not really on our radar, and Starwood and ICG are both winding down, so not much there, but I do quite like real estate credit investment. The only thing I would say is, again, you're not getting capital growth, but also you're not getting dividend growth. So that dividend is just fixed. It's 3p a quarter, it hasn't changed, it hasn't grown. That's not the same as an equity income fund.
Yeah. Growth capital. And again, exciting sector. And the top of the pops there is Seraphim, which has just carried on going this year. I mean, it's had a great start to 2026. Having been very much out of favour, on the back of the interest rates going up and growth selling off and all that sort of stuff, and going out to a big discount, it's now trading at a premium, which is incredible, really. But I think that it was a case of investors just not being patient enough, really, with this stuff. I mean, it was still a relatively new fund, and it had to make these investments, and then they take a while to come right. But they are coming right in spades, and especially Eyesight, which is its biggest holding. It just keeps winning big contracts with national defence agencies, because this boom in defence spending that we're seeing is being really good for the whole space industry. So yes, there are lots of non-defence aspects to what they do, but the defence side of things is potentially still quite a big driver of returns here to that. So when we talk to the manager, he says lots of his companies could be multi-billion market cap companies, and so he thinks there's still a lot more upside to come. Next on that list is Shahadian, which is obviously SpaceX again. That's been a big winner, and also I think Anthropic and all those other big Baillie Gifford winners. And then we've got Chrysalis, which is maybe not quite so exciting, but it has finally got this Klarna IPO that it's been talking about for ages done. And again, maybe not the valuation that it wanted, but it still sees more upside in that. And the way that it's structured, it can hold it even after it's IPO'd. But they're getting big uplifts in the valuations of Starling, and a bit of a rebound in WeFox too, which is the insurance company that had a sort of wobble last year. So that I think gradually that is building up a decent track record. And again, it's about patience and there's a kind of push for it to stop making new investments. I don't really agree with that, to be honest. I think it should have been allowed to carry on going. Unfortunately, at the bottom end of that thing, you've got Schroder British Opportunities Trust. Again, it might be that we just need to be a bit more patient with it, but it has struggled a bit, unfortunately. And then in the middle, we've got the old Patient Capital. But
well, I was smiling when you said the word patience, because Schroders, Schroders Capital Global Innovation is, of course, the old Woodford Patient Capital, and I think most people were impatient and got out, perhaps. But one that's catching my eye there is Molten Ventures. Flat in NAV terms, it seems, but shares are up 58%, so quite a re-rating.
Yeah, it's got Eyesight. It's got some interesting investments in there, but somebody pointed out to me it's got a tendency to sell things when they come good rather than hang on to them. So it maybe is missing out on some of the upside. I don't know. hedge funds.
Hedge funds, yeah. A sector slightly soured, I think, by the exit of Third Point investors earlier this year on really horrible terms. And that was very upsetting, I think, for many shareholders. And I think that means actually there's quite a trust issue here, that where you've got managers saying, look, we take a black box approach, just trust us. Actually, I think investors are less inclined to do that nowadays. And BH Macro, I think, is a very interesting case. You know, this is a trust that has been recommended actually by quite a number of major stockbrokers. I think it's highly regarded. But in spite of the turbulence that we saw, in particular in the first part of the year, it really hasn't benefited and it's had quite a poor year. If you're a Times reader, you'll notice today there's quite a big section on the flamboyant founder of BH Macro, of Brevin Howard. And they have had a bit of a poor year. But actually, I think that trust is quite interesting. We were talking earlier about trusts like capital gearing and personal assets. If you're a bit worried about markets and you do think there's going to be a major setback, probably triggered by the US, and how do you protect your money? I think BH Macro is actually one still to consider there, because it does have a very good track record during those really turbulent markets. I put on the slide here that since inception in 2007, if you pick the worst 20 months in equity markets over that period, BH Macro has made a profit in 17 out of those 20. So I do think it's worth considering as a hedge in your portfolio if that's what you're looking for. So a poor year overall, but it could come good during really tough times.
Cool. Okay. Infrastructure. Now this should be steady Eddie boring, and it's been anything but really. We've had quite a lot of stuff going on here. Bottom of the table is the dreadful Digital 9, which we probably don't need to go into anymore. They just have taken a big haircut on the valuation of the Arqiva investment, which is the broadcast house for digital TV, so for broadcast TV. Other end of the table, though, is Cordiant. And Cordiant was dragged down by digital in terms of the share price. If we sort of lump them in together, but actually you can see the difference in the skill of the management team here. And I do like the manager at Cordiant. He's pouring money, his own money, into the stock as well. So he's got a big personal investment and stuff. And it's got some investments in Eastern Europe, in Poland and Czech Republic, that are actually doing very well. So they're seeing good growth. And there's the whole sort of digital infrastructure thing is actually still quite a strong investment idea. You're seeing it in things like data centers as well as in the broadband stuff and the cables on the ground stuff. So, and data centers have been a big driver of things like Pantheon Infrastructure too. They've made a couple of good disposals. And then 3i, we wrote about recently. That's got a very good, solid long-term track record of investing in infrastructure, but not the sort of boring side of infrastructure, safe side of infrastructure, more taking a little bit more risk and getting a bit more return on the back of that. It's got its biggest investment up for sale. We could see a decent uplift in that maybe when they do announce that disposal. So, and then in the middle of all of that, we've also got Hickle, which is his dreadful attempt to buy Trig, rightly rejected by investors. And now I think is maybe sort of in play really, because there's a lot of angry investors out there. I'll have to wait and see what happens with that. On the leasing side of things, we think we can probably skip through this. We're talking about the plane funds and the ship fund. The planes are disappearing fast. Emirates is basically, as they're coming to the end of the leases, Emirates is buying the A380s off them. It's still managing to make money out of these things, and they are refurbing them and kind of carry on going with them. The Amadeus has also got exposure to Thai Airways, which went sort of bust in the back of early on. Has actually come out of bankruptcy now, and that should help it a bit. Tufton, it's had a problem really with a bit of low demand for its vessels, but it has been selling vessels off and then using that money to buy back stock. So which is why the share price I think is a bit better than the NAV there. That could still come good. I think they know what they're doing, these guys. And you can see the 5-year numbers are still not too bad, although you know the more recent stuff has been a bit weak. Private equity, so I'm rattling through these as I'm conscious of time. But this is a big sector and we've got to focus on this. 3i again tops the table, and again it's all about action, and that has just grown and grown and grown and grown and driven that NAV higher and higher. But it finally had a bit of a wobble after decades of uninterrupted growth. They were worried about sales growth in France, I think in particular, and that brought the premium down, and so you got a big gap between the NAV and the share price there. That premium is still fairly high though, so we have to wait and see whether that wobble is extended or whether it was just a one-off. But generally, the private equity stuff has not been very exciting, and there's become on the back of a lack of exits. But these are starting to pick up now, and so I am a bit more optimistic for the sector, providing nothing else goes wrong with markets. I'm a bit more optimistic for the sector going into 2026. But at the bottom of the table, you've got these things that are in wind down and where they're getting disappointing numbers on what they're selling. And so, yeah, I leave one alone. And it's an example of what you were saying about, Andrew, about normally you want to be in these things as they wound up, but actually in these cases, no, you don't. Maybe the only other interesting thing in that lot is the fact that HG lagged a bit. Normally that's the top of the pops. That's slightly reflected in that share price move as well. We'll have to wait and see. We know we've been pushing Oakley as like having as good long-term track record as 3i. As HG rather. And you have seen a sort of slight narrowing of the gap between the ratings of the two. I can still imagine that Oakley and HG will end up trading the same rating in the end. Cool. And then renewables, another big sector and really very disappointing. Now I've been pushing and pushing this. It's like, you know, it's not as bad as it looks. And it does seem to be as bad as it looks. The problem has been really about they've just had this constant drip of cuts to power price forecasts. And that's affecting the NAVs. And that doesn't seem to have stopped yet. I'm hoping that it will do soon. But I think investors are losing patience. So obviously the discounts are just enormous now. It is affecting things that are highly geared. So you've had things like Next Energy, you know, goes around it's gearing because on the face of it, that looks like to be over 100%. Although a lot of that gearing is preference shares, which are not the same thing as bank debt. So it's maybe not a lot less scary than the headline might suggest. But we've had more of these things now to say, this isn't working, we are going to wind down. So VH Global is at the top there as one of those. Again, you've had some disappointments in some of these wind downs. And we were talking about Rob Naylor early on, that he's gone in there, the Quillo one down the bottom there, where it's been taking some haircuts on things. And then very bottom of the table, you've got hydrogen capital growth. Which I was a bit sad about really. I still think that had it had sufficient capital and time, it would have been okay, but it was just not able to support some of the things it invested in, and so they started running out of money, and then one of these things, Prime Energy, has gone bust. But yeah, this is probably best left alone now.
Are the battery funds? They had a terrible 24, and the share price returns on Gresham House and was really good.
Yeah.
And Gore Street.
Less so.
That's less so, but it's positive.
Mm-hmm.
Obviously, they got really crashed in 24. But with Gresham House, with Grid, is that some sort of endorsement for its 3-year recovery plan? Or was it just so bombed out? It
was very bombed out. I think there maybe is people are slightly more relaxed about it now. They're definitely all the things that the big problem they had was that they couldn't actually transact with the National Grid ESO in terms of like supplying power when the grid was short of power, and that was the National Grid systems, and that needed to be sorted out, and that is being sorted out, and that's starting to flow through into revenues now. But they also need the sort of volatile power prices, and as power prices come down, that affects the range of the numbers that they've got to play with, so that weighs on them. Grid's done these deals where it's basically got secured some kind of guaranteed minimum levels of income, and maybe that's helped a bit in terms of reassuring people. I think the thing about battery storage relative to the wind and the solar stuff is the revenue, the long-term revenue forecast is just a bit more up in the air, because it's harder to know exactly how things are going to pan out. And it's been interesting. Just turn to Gore Street, for example. They've got this stuff in Texas where year before last, it was just made them huge amounts of money because there was a big shortage of power when they had sort of very hot summer, and it was turning the air conditioning on, and then and then now. Last year it was really quite pitiful. So yeah, you get these big swings in income, and that's not related to anything external. That's just genuinely the amount that they're able to earn from these markets, and it is just a bit unpredictable. It depends on the weather and stuff like that. So yeah, don't know. Property.
Yeah, UK commercial property. We have seen an upswing in property, which obviously had a very difficult period when the zero interest rate period ended, and suddenly the gearing which all property companies have became much more expensive, and that made it much more difficult for them to make money. And we saw big discounts open up, big falls in the sector. And we've seen enormous rationalization in this sector. Obviously, we've been talking about consolidation all the time for the last 2 years across many sectors. And I think property has probably been most affected, actually. There have been more deals in this sector than any other. And there's quite a range of trusts here. There are some of these figures here which don't quite make sense because the trusts are in wind down. So Aberdeen Property Income Trust at the top there, that's just the tiny rump of what's left. But there are still some interesting trusts in this sector. AEW UK REIT, sorry, AEW, I beg your pardon, AEW UK REIT has been top of the table for many years. It hasn't quite made it this year, but it's still reasonably positioned. And I think there are some other interesting ones here. Alternative Income REIT, I looked at a couple of months ago actually in my newsletter, and it looked really attractive at the time in spite of a dividend cut, because it still had a fantastically high yield, big discount. And actually the price has rallied there, so it's not quite the same value proposition. But it was just an example for me of trusts that are somewhat overlooked here, not that well known, not that well investigated, but offering good value, particularly from the high dividend yields. Just two things to point out other than that. One is Life Science REIT, pretty much at the bottom there. It was already showing an 11% loss in NAV over the year, but that worsened very considerably this morning, actually, when they announced an updated NAV, and it came down from 66.3 pence to 57.7. So a considerable write down there, which was due to difficulties in letting, and also the fact that the valuers have effectively reclassified its Camborne holding away from life sciences towards an office property valuation, which is lower. So it's quite difficult for Life Science REIT at the moment, but the shares are trading considerably below that NAV. The trust is in managed wind down. But with Rob Naylor on the board, I wonder whether they might be trying to do a deal for the whole thing. I think the difficulty for Life Science REIT is that it has some really nice assets, and I think the London asset is really attractive, but then some of the others not so much, and hence the Camborne write-down. So we'll see what happens with that one. Another trust I think could be in play and quite interesting is Schroeder Real Estate Investment Trust. Actually a pretty reasonable performer. But what's interesting there is that London Metric has an 11% stake. And London Metric has been a serious consolidator in this sector. And it's raised its stake there. It started out, I think, at 8 or 9%. It's gone up to 11. And that trust is still on an 18 discount. So there could be a bit more value there to be squeezed out.
Yeah, well, actually, on that note, Andrew, that's mentioning London Metric. They've also got a stake in, if you mentioned that kind of thing, in Value and Index Property Income, the long lease fund run by Matthew Oakeshott. They took 9%, a bit after they bought the position in Schroeder. Yeah. So, and that's a really acquisitive company. Obviously, bought Urban Logistics last year. So, yeah, speculation about what's going on.
Yeah. To my mind, it feels very much like investors have sold these things at the bottom again. And London Metric is the canny operator that's gone, actually, I love that. Thank you very much. Because I can see the upside in the NAVs, you know. But there we go. This is what happens. Now, some of the more specialist property sectors. Target Healthcare REIT, that's actually not a bad number again. It's actually quite a consistent performer. I think it helps that it's got inflation-linked rents in its portfolio. It's kind of high quality dementia care homes, and there's very good demand for that stuff. And it's been quite good at selling off some of the smaller stuff and buying new things. And, you know, I do rate the managers there, and they've done a good job. And you've seen them re-rating the share price as well. Another big acquisitive company has been Tritex Big Box REIT, and it's built up its portfolio going into more last mile stuff from the big boxes. So it's you know, so that's broadened out what it does, but it's also got a data center play as well. So it's outside Slough. It's got one that is building now, and more land that it's got identified as places to build data centers. And in the UK, I get the sense that we just don't have enough data center capacity, and aren't going to, because of this problem where if you need it, if you're going to put it in, you have to get the grid connection, and the National Grid's not been very good at sorting that out. So if you've got the right place, the right land parcels in the right places and the grid connection, that's actually worth quite a lot of money. And then on the residential side of things, a lot of it is sort of headed to the exit one way or another. So PRS REIT is obviously disappearing very shortly, and the numbers on there aren't, you know, really anything to write home about. We're still waiting for Home REIT to relist. I don't know if that's ever going to happen, to be honest. You know, it just beggars belief that it's taking so long to get these accounts published. Yeah,
yeah, 3 years in this month.
Yeah, it is just
ridiculous.
Crazy. There we go. And yeah, ground rents just carries on being dreadful. And then European property, Schroeder European is a decent fund, I think, but it has actually got an issue now in that it's got its biggest investment. The tenant has quit, so it's got to try and relet that. If it manages to do that and do that at a decent rate, then I think it's set fair, really. But it does put a question mark over it, which is a shame because it has had a quite good year otherwise. Some of these other ones are really not worth talking about. Phoenix Spree I always liked, and it's actually done quite a good job. It's in wind down, but it's done quite a good job of selling stuff last year at decent prices. So it'll be handing back money soon, I think. And then the other things are tiny generally, and really not worth talking about unless you've got a penchant for it. I just found it big belief again that Macau Property Opportunities, which has been in wind down for ages, somehow still managed to have so much debt that it breached its banking covenants. It just, I think that board should be taken out of shot, to be honest, but there we are. And that's it. I can't believe we've done it. And it's like it's a marathon session. Thank you very much for everybody that tuned in. Thank you for Andrew, all the work you do over the year. It's been really, it's always these things are always good fun every month. And welcome again, Gavin, and we expect to see more of you over 2026.
That'd be great. Thanks, James.
We'll be back next week talking to Richard Sen from Pantheon Infrastructure. You get the name right. And so please do have a good week and have a good weekend, and we shall see you soon.